For years, foreign capital has been fleeing India. Now, it's pouring into Indian debt, but staying away from equity. Why is this happening? Let's break down the players first. FPIs or foreign portfolio investors are overseas funds and institutions that invest in Indian markets, either in equities, which means stocks, or in debt, which basically means government and corporate bonds. Think of debt investment as lending money to India and earning interest versus equity investment, which is buying a piece of a company and betting on its growth. Now, in June, FPIs poured in a record 41,773 crore rupees into Indian debt, specifically bonds, under something called the Fully Accessible Route or FAR. That's a category of Indian government bonds that foreign investors can buy without the usual investment caps. At the same time, they pulled out nearly 49,340 crore rupees from Indian equities. So, like I said, debt is booming, equities are bleeding. Why? 3 reasons. First, the rupee. Our currency had fallen to record lows of nearly 97 to the dollar in May, but it's since recovered to around 95.2. A stronger, more stable rupee makes debt investments far less risky because you're not just earning interest, you're also protecting your capital from currency losses. Second, and this is the big one, there's growing expectation that Indian bonds will finally be included in Bloomberg's Global Aggregate Index. This is a benchmark index that guides how hundreds of billions of dollars of global passive money gets allocated. If India makes the cut, a wall of automatic money follows. This has been long awaited and somewhat delayed. Now, everyone's positioning ahead of that decision, which is expected this month. Third, government tax sweeteners. India waived capital gains tax and interest tax on these bond investments, making them even more attractive. But then, on the other hand, equities are a different story. Indian stock markets run on company earnings and future growth expectations, not just currency stability. And 2026 has not been kind. The Nifty 50 is down more than 8%, and IT stocks, usually a favorite, have crashed nearly 30%. Add to that the global macro uncertainty from the Iran war and its impact on oil prices and corporate earnings, and you have a scenario wherein foreign investors are simply waiting on the sidelines for more clarity. There's also a quirk worth understanding here. Even though all this bond money is flowing in, India's foreign exchange reserves, basically the RBI's treasure trove or war chest of dollars, have not grown proportionately. That's because, unlike older schemes like FCNRB, deposits of ECBs, which are essentially foreign currency loans routed through Indian banks with RBI backing, there's no facility that converts this FAR bond money that I just spoke about into official reserves. It just sits in bank books. And there are real risks ahead. If the US Federal Reserve turns hawkish and raises interest rates, the gap between US and Indian bond yields, right now around 2.4 percentage points, could shrink. That gap is called the carry, and it's the extra return foreign investors get for taking on India risk. If that carry shrinks too much, this debt party could reverse just as quickly as it started. So, in this episode, I asked my colleague and the writer of the FPI story, Rozebud Gonsalves, 3 questions. If Bloomberg defers Indian bond index inclusion again this month, what happens? Is the government considering any scheme to convert these bond inflows into actual forex reserves the way it does with FCNRB or ECB money? If Bloomberg defers Indian bond index inclusion again this month, what happens? And if the Fed turns hawkish while Indian yields keep falling, will foreign investors still find it worthwhile to hold Indian debt? Listen on, it's Tuesday, the 7th of July. I'm Anirban Chaudhary. This is the Morning Brief. Hi, Rosebud.
Hey Anirban.
Good to have you. So, your story today says FPIs are blowing hot and cold. That is, they're doubling down on Indian debt and still holding their horses or purse strings when it comes to equity. But this is obviously a positive change from the flight of foreign capital we've seen in the last 2 years, right?
So, yes, inflows of any form are really good. And what we saw in June were massive inflows. So, we had over 40,000 crores in debt. To put this in perspective, when India was included in the JP Morgan Emerging Market Index, the maximum we had received in a month was around 22,000 crores. But overall, experts are sort of questioning the sustainability of such flows because these can as easily become outflows very quickly. Factors like global rate cycles, geopolitics, inflation expectation, currency stability, all of these play a role here.
Got it. Now, Rosebud, regarding the FAR debt inflows, what are the government's plans? Is it planning to create a scheme to convert these bond investment dollars into official reserves too?
So, see, we do not know anything about this yet, and this is a tricky thing to do, unlike the FCNRB or the ECB scheme. So, see, in the FCNR deposits or the ECB policy, we know for sure that the money is coming in for a set period, be it 2 years, 3 years, or 5 years, but we know the tenor. But when it comes to FAR inflows, this is money that global fund managers are actively putting into India. So think of it like you are investing in the Nifty index. You can as easily remove the money at any time, and so can the fund managers take out the money from India at any time. So, since the tenure of these funds is tricky to determine, a scheme like RBI taking over the hedging cost, like in the ECB or the NRI deposit scheme, is a little unlikely.
Okay, now coming to external factors, and this is an important one. Bloomberg has previously delayed or deferred adding Indian bonds to its global aggregate index, which is a big one. If it defers again in July, how much of the current debt inflow that we are seeing now reverses, and what part of it merely stalls?
Now, see, a lot of buying is happening because the index inclusion is expected. I mean, in just the first 3 days of July, FPIs bought over 5,000 crores of Indian debt. In the previous fiscal year, we had such inflows spread out over a month. So it's hard to quantify in absolute terms what the outflow would be if the inclusion is deferred. But from a yields perspective, Treasury heads expect a hardening of 10 to 15 basis points in the 10-year benchmark bond.
Got it. Now, another external factor, if the Fed raises US interest rates while Indian rates keep falling, will the FPIs still hold Indian debt?
So the straight answer is no. US 10-year bond yields around 4.3% and ours yield around 6.7%. This is the 10-year benchmark bond. This is a difference of around 2.4%. But if US rates rise, this 2.4 easily becomes 2.2 or even less. So, why would a global fund manager invest in India when the world's biggest bond market has such high yields? Normally, emerging market bonds like Indian bonds shine when US rates are really low. People who would still hold Indian bonds would have some sort of a mandate that certain percentage should be invested in emerging markets.
Okay, now finally, Rosebud, is a debt led recovery in foreign inflows enough to keep the rupee stable, or is equity, which is not attracting enough foreign inflows now, is that more critical?
Now, see, equity inflows are very important. For debt inflows, a stable rupee is an important factor. But for equity inflows, a more important factor is corporate performance and profits. Rupee is a secondary factor. So, this is how it works. Good corporate performance leads to good equity flows. Good equity flows stabilize the rupee, and a stable rupee attracts debt inflows.
So there you have it. India's foreign money story right now is really a tale of two asset classes. Debt is riding high on rupee stability, tax breaks, and Bloomberg index hopes. Equity remains cautious, waiting on earnings and geopolitical clarity. But nothing here is guaranteed. A hawkish Fed, a deferred index decision, or a fresh oil shock could quickly change the picture. That's it for today. You were listening to this episode on The Morning Brief. It was produced by me, sound designed by Radhis Naik. Keep listening to our podcasts on your favorite listening platforms. Stay tuned.